Hey guys, what is up? Welcome back. So, how to shop for mortgages as a first-time buyer. So in today's video, I basically wanted to demystify the whole topic of mortgages, because I don't know about you, but for me, when I first started reading up on mortgages, all the terms and technicalities behind it really sort of just confused me. And so today I basically want to break down this area for you guys and make it as easy to understand as possible. Okay, so mortgages. First, let's talk about LTVs. So you've probably seen this abbreviation all over the place, and maybe you don't have a full understanding of what it really is. An LTV is loan to value. What that basically is the proportion of the property that you own versus that which is taken out on a loan, essentially your mortgage. So for example, let's say you've got a property that is worth £200,000, yeah? If you put down a 10% deposit, which is £20,000, that means your loan to value is 90%, because essentially you're using 90% of a loan from a bank or lender to pay off the property. Right, now, so let's really get into this. What are the different mortgage types? So generally there are 4 types of mortgages that you can get. You can get a fixed, you can get a tracker, you can get a standard variable rate, also known as a SVR, or you can get a discount mortgage. Okay, so let's start with fixed, because that's currently what I'm on. A fixed mortgage is essentially whereby you pay the same interest or your monthly mortgage repayments stay the same throughout the entire deal period. The reason I personally went for a fixed is because it helps with financial planning, and it basically helps you to identify what exactly it is you'll be required to pay each month. Right, on to the next type, which is a tracker. So with tracker mortgages, the interest rate tracks out of the Bank of England base rate, and then with an additional percentage on top. Standard variable rate. So an SVR, in short, basically is set by the bank or lender. They're in charge of choosing what their SVR is. This is not based on any external forces like a tracker mortgage is. A discount mortgage basically follows the lender's SVR rate with an agreed discount that you'll pay throughout the deal period. It's important to note, however, that regardless of what mortgage product that you choose in the first place, after the end of that deal, so whether it's a 2-year, 3-year or 5-year mortgage product, it will return to the bank or lender's standard variable rate, and more times the standard variable rate will be the highest that you can pay. So this is why a lot of people will then go on to remortgage before the deal ends, because they don't want to be paying that higher rate and they'd rather choose a cheaper, more affordable deal. So in about a year's time, I myself will start looking for a new mortgage deal, because mine is a 2-year fix, and so after that term I do not want to go onto the lender's SVR. I'd rather find a better deal for myself. Now let's talk mortgage terms. So you probably would have seen or heard of figures ranging from a couple of years right up to 40 years. The truth about mortgage terms is that there is no right or wrong answer, okay? This is based on your individual circumstances. This is based on things like your income and your age. Now let me break that down. With longer term mortgages, so like your 30, 35, 40-year mortgages, you'll pay more interest over the term of the mortgage. That is because your mortgage is stretched out over a longer period of time. But the truth is that you can always overpay on your mortgage payments. So that is, if your monthly mortgage payments are £600, you can choose to pay like an additional £200, £300 on top of that. Or you can even look into asking your lender to reduce your term if you feel like you can afford to make higher monthly mortgage repayments. Now the benefit of having a longer term for your mortgage is the fact that this can be more affordable and your monthly mortgage payments will be lower. Also, if you're on a lower income in comparison to the value of the property that you want to buy, or let's say your income is not that high in comparison to the amount of expenses you have going out on a monthly basis, a mortgage lender or bank may feel a lot more comfortable to offer you a mortgage if you accept to take it on a longer term, because it'll sit nicely within your affordability. Obviously, this also depends on the property value itself. Now, with your shorter term mortgages, so let's say your 2 years, 5 years, 10-year mortgage terms, obviously you'll pay off your mortgage a lot sooner, and you'll also be paying off less interest during the term. However, as I've mentioned earlier, there is no right or wrong answer. Don't let the fact that at face value you think you'll pay less interest on a shorter term mortgage, don't let that be the reason why you opt for that, okay? You can always choose to overpay on your monthly mortgage payments if you can afford to, or you can go back and ask your lender to reduce your mortgage term if you think that it's something that you can afford in the long term. I will say, however, that most lenders do have a sort of like maximum that you can overpay each year. So if you know that you plan to overpay more than that, you may want to have a conversation with them to see what the fees are going to look like. So anyway, to summarize mortgage terms, if you're somebody that's on a higher income, you'll be able to afford to get a shorter term mortgage. If you're somebody that's on a lower income, you're probably going to have to go for a longer term mortgage. If you're somebody that's on the older side, you may have to go for a shorter term mortgage, and this is because a lot of lenders are not going to be willing to offer you a mortgage that's going to go beyond your retirement age. So for example, if you're a 50-year-old and you're trying to get a mortgage, you're unlikely to be given a mortgage deal that's beyond, let's say, 10, 20 years, because that's going to go beyond retirement. And now on the other side, if you're a younger person, you have the option to take a longer term mortgage, so you can get a maximum of a 40-year term mortgage, or you can choose to go for a shorter term mortgage if you can afford it. Clear? Mortgage product terms. So we've spoken about mortgage terms, but now let's talk about mortgage product terms. So as I mentioned earlier, your mortgage product is essentially like the fixed or the tracker or the SVR or the discount mortgage. Now the term relates to the number of years that deal lasts for. You usually get like 2, 3 or 5 year deals. Now the mortgage product term is not such a biggie, and the only reason I thought to mention it in this video is because of the fact that if you're somebody that doesn't want to remortgage too often, you'll probably want to go for the longer deals. So that is maybe like your 5-year deals, because the thing is that when you go to remortgage, which is basically when you want to move from one mortgage product to another to avoid the standard variable rate, you may have to pay a fee, and those fees are associated with maybe moving from one lender to another, so an exit fee as well as legal fees as well to get like solicitors to do the stuff they need to do. If however you remain with the same lender but you're just moving over to a different deal, you'll probably avoid those fees, and so that's all good. But I definitely just wanted to give you guys the heads up that, you know, if you're somebody that doesn't want to remortgage too often, either because of the cost associated with it or just the general like work, then I'll probably say go with the longer term product deal over the maybe 2 year. Another thing to consider, however, is the fact that if you do go for the longer end of mortgage deals, then you may potentially miss out on good deals that arise during your term. So for example, if you choose to go for a fixed mortgage and you take on a 5-year deal, within that 5 years a better interest rate may come up. So in summary, if you're not too worried about missing out on good deals during your term, then maybe you go for the longer deal. But if you're worried about things like that and would rather keep your eyes open and be able to move to another deal when you see it, then I'll go for a shorter term mortgage deal. So interest rates, or annual percentage rate, also known as the APR. So most people will be looking at for the lowest APR, and that definitely makes sense. But here's the thing, don't get caught out just looking at the APR and forgetting the fact that some mortgage products will come with an arrangement fee or product fee. So let's say for example you found a mortgage product that has like a 1.9 APR versus one that has like 2.5, for example, yeah? But let's say the 1.9 has a mortgage product fee of like £1,500, whereas the product that has the 2.5% APR has no fee associated to it. So if you do your calculations, you may actually find that the one that has the mortgage product fee, although the APR is lower, you may see that it's a lot more expensive for you in the long term versus the one that has the higher APR but has no product fee. Do you get where I'm coming from? So you definitely want to keep a lookout for fees associated to your mortgage products rather than just focusing on the APR, because that's not all that matters. This was definitely something that my mortgage advisors alerted me to when I was looking for mortgages for my house. So in summary, read your mortgage terms and conditions very carefully and make sure you know what you are paying for. Don't go for the lower APR if all in all your costs are going to be higher because of your product fee. Repayment versus interest only mortgages. Right, so what do they mean and what are the differences? So with a repayment mortgage, you're essentially paying off everything. That is the capital for the property as well as the interest over that term. And now interest only mortgages, these are not very common nowadays at all, and especially not for first time buyers. And this is because with an interest only mortgage, you're basically only paying off the interest throughout your mortgage term. So let's say it's a 30-year mortgage, okay? Over those 30 years, all you're paying off is the interest. So that is, the capital still remains. So if you bought a house worth £200,000, over those 30 years, you've only paid interest. You have not even touched that £200,000. So at the end of those 30 years, you owe the bank or lender a huge lump sum of £200,000, yeah? All in one go. Can you just imagine? So you can see how risky that is and why mortgage lenders aren't really offering those types of mortgages to people. To be able to get that type of interest only mortgage, you need a really strong case to prove how you'll be able to pay off that lump sum of money at the end of the term. Right, so guys, that brings me to the end of this week's video. I do hope you've enjoyed it and find it useful. I hope I've demystified this whole mortgage like topic. I hope it's not as confusing as maybe you once found it. I hope that now when you go out shopping for mortgages, you do it with a whole lot more confidence, understanding what you're getting yourselves into, understanding the different terms. Thank you for watching and I'll catch you next week. Bye.